Welcome back to the Fire Grind. My name is Daniel, and on this channel we talk about personal finance with a focus in the stock market. And in today's video, we're going to be going over 3 different stocks on the Canadian stock market that I'm looking to buy in the month of August. So for each company that we go over today, I'll be talking about 4 different things. First, we're going to start off with what the company does or the business. Second, we're going to talk about the financials. Third, we're going to go over why I'm interested in purchasing the stock for the month of August. And fourth, I'm going to go over the risks of each of these companies. And just a note for you guys, I'm filming this on July 29th, so all the screenshots might be off by 1 day or 2, depending on when I edit. Before we get started, I have a sweet offer for you guys. Down in the description down below, if you sign up for a dentist appointment with OpenCare, you can get $75 in either a Visa gift card, Amazon gift card, and I think there's also a Nike gift card option. All you do is you book a dentist appointment with OpenCare, go to that appointment, and prove that you went to your dentist appointment. And especially for those of you guys who are working and have benefits, your dentist appointment is either 80% covered, 90% covered, or fully covered by your health insurance. So why not book a dentist appointment and get $75? Note this offer is only valid till August 3rd, and if you're watching this video after August 3rd, the gift card amount will be $50. So still pretty good. Now let's jump right into the content. The first stock we have on this list is Docebo. Its ticker symbol is DCBO. And this company actually IPO'd last year in 2019 in the month of October. Right out of the gates, Docebo traded for $16 per share, and today it actually trades for $40 per share. So early investors have seen their investment double. So what does the company do? Docebo is a learning management platform that improves enterprise learning. So let's break this statement down into 2 different parts. The first part is the learning management platform, or also interchangeably called the learning management system. A learning management platform is a software platform that allows customers to deploy and track online learning initiatives. Docebo's learning management platform reduces admin work to set up and maintain, intelligently categorizes content using AI, gamifies learning, and allows users to share knowledge. What's different about their platform is a social aspect. They allow users to upload content to share with other learners, which makes the learning environment so much more enriching. So for example, if Bob is a car mechanic at this auto shop and he finds a new and improved way to change an oil filter that saves the company 10 seconds per oil change, he might film his process and put this video up onto Docebo's platform such that other mechanics can search his method of how to do an oil change. And how this is very useful for the company is that everyone who's part of the organization or part of the platform is able to add knowledge or content to the system. And this allows a lot more content to be uploaded to the system so that it's not just instructors who are putting information into the system, but also learners who are also developing their own skills on the job and using and applying these skills day to day. So what enterprise learning is, it's essentially learning under an enterprise or company versus learning at an educational institution. And for those of you who are in the workforce, you know that learning doesn't stop once you get on the job. We know that as we go into the job, we have to pick up new skills day to day as the world's evolving and technology is evolving, processes are evolving, and even social things are evolving. So as an employee, you have to keep up to date with the latest trends or latest technology to be on top of your game at your job. So how does the company earn money? The company operates under a SaaS model with an annual subscription fee, and it's prepaid on an annual basis. So this means that Docebo is able to keep their customers for at least 1 year before their software is reevaluated and whether the company wants to continue with their contract or not. This provides stability for Docebo's earnings for 1 full year with each customer, which is typical for a software as a service company. With many different software product offerings, Docebo is not only increasing their revenue by adding new customers, they are also upselling their current customers on additional services throughout the lifetime of that customer. As their customers, which are businesses, grow, their demand for an LMS increases. This could be an increase of users on the platform, or an increased number of content, or the increased number of instructors who want to upload content. Who are Docebo's customers? Docebo's platform is now used by more than 1,900 companies of all sizes, providing access to learners situated around the world in a variety of languages. Their clients range from select small local businesses with a focus on mid-sized enterprises to large multinationals, including service, financial, technology, and resource-based companies and consulting firms. The platform is sold primarily through a direct sales force with offices in Toronto, Canada, Athens, Georgia, USA, Bolzano, Italy, and London, United Kingdom. Docebo also has some relationships with resellers and other channel partners, such as human resource and payroll service providers. Now turning over briefly to the management of this company. So when I looked at the management of this company, the CEO and the CTO both have been at the company since it started in 2005. So this is great because the CEO understands the business very well, and the CTO, who's driving all the technology in the business, also has a very solid understanding of what the company needs. Their CFO also has a lot of experience in publicly traded companies, and he's been in companies that have been listed on the TSX, as well as companies that have also been involved in mergers. So in my opinion, the management for this company is fairly strong, and we can see this with the growth of their business and how they've conducted operations year over year to grow the company to this size. Now turning over to the financials. If we look at their financial statements, we can see that the company managed to squeak out a profit for Q1 of 2020, and this profit was $717,000 USD. And this is the first profitable quarter that they've ever reported as a company. If we look at their balance sheet, they have a current ratio of 1.87, which is very solid for this company, and it's going to allow them to continue operating even though they might see losses in the future. They also have enough cash to cover all their liabilities. This is not the total current assets, but this is the cash portion of their current assets that's able to cover all their liabilities, which is a very good sign to me as an investor. They're also currently growing their revenues at a 50 to 55% clip year over year, and they have a healthy gross margin of 80%. So now, why am I interested in this stock? So first of all, the reason why I'm interested in this stock is because of their high growth. As they're growing their business 50% to 55% year over year, I think this company makes a great growth company on the TSX for me to invest in. And I think that as companies move more towards a work from home model, LMSs will become more important because this is how they can spread information throughout organizations. So Docebo is able to capitalize on this trend that's happening within businesses today and provide their services, and I believe we could potentially see higher growth in the years to come. I also think that technology companies in Canada are a little bit undervalued compared to the US counterparts. And with Shopify paving the way for Canadian tech companies, where Shopify has now become the largest company on the TSX, surpassing Royal Bank, a lot of Canadian tech companies are going to see a bit more light shed on their stocks, and I think more investors will start flooding money into Canadian tech stocks. And we've already seen this with Docebo, as they've seen their stock price more than double in less than 1 full year of being a public company on the TSX. This company also has very solid financials, which gives me peace of mind if I'm going to invest my money into this company, that they're going to be able to wisely spend their capital and grow this business. Also, the social aspect of their learning management system is very interesting to me. And for me, as a self-learner, I often go to YouTube for a lot of my content that I want to learn how to do things. For example, I would look up how to do tiling for a backsplash, which I'm planning to do in my apartment right now on YouTube. I also go to YouTube for investment ideas and other various things in life that I can learn which are better taught visually. So I think Docebo's platform is very good for companies, as employees can show other employees what they're doing, especially if they're not in the office together. Now turning over to the risks for this company, there are a few risks that I see going forward. On the investor presentation that Docebo shows to the public, the competitive landscape seems pretty crowded, with a lot of companies coming out with different learning management platforms. And this is the risk going forward as an investor in Docebo, is that knowing that the landscape is fairly competitive, Docebo has to continue to execute flawlessly to be able to capture more market share and grow its business. If they falter in their execution, we could see the stock tumble from its highs of $40 today, possibly back down to its IPO price of $60, where the next support level is. Another risk is the company has not had much history as a public company. So we don't have too much history about how the company operates, and there's only so much information that we can dig up on a new listed company. And lastly, the company is not yet profitable, although it did squeak out its first profit this quarter. This means that the company has not seen green pastures yet, and I expect as a growth company, they still will continue to churn out losses quarter over quarter, and they might have just gotten lucky and the circumstances aligned that they were able to squeak out a profit this previous quarter. The next company we have on this list is TD Bank, and I spoke about TD Bank briefly in my previous video on 6 stocks for beginners. But now we're going to go a bit more in depth into TD Bank. So what does the company do? TD is the 6th largest bank in North America by branches and serves over 26 million customers in 3 key businesses, operating in a number of locations and financial centers around the globe. TD ranks among the world's leading online financial services firms with more than 14 million active online and mobile customers. On April 30th, 2020, TD had recorded that it had $1.7 trillion in assets. So how does the company earn money? So the 3 different segments of business that TD operates in is the Canadian retail, the US retail, and wholesale banking. Within Canadian retail, this includes TD Canada Trust, business banking, TD Auto Finance, TD Wealth, TD Direct Investing, and TD Insurance. For the US retail portion, they have TD Bank, America's most conventional bank, TD Auto Finance USA, TD Wealth USA, and TD's investment in TD Ameritrade. For wholesale banking, this includes TD Securities. If you want to find out a bit more about each segment of these businesses, you can search these on Google online. So why am I interested in this stock? First of all, I'm interested in TD for its dividends mainly, and TD has a good track record with its dividends, and it's been growing its dividends since year 2000, 10% year over year. And currently, its dividend yield, according to Google Finance, is around 5.28%. The stock is also down around 25% from its all-time highs, which makes it look fairly attractive right now. And with its US expansion, TD Bank has not yet hit its limits because it's continuing to expand in USA. Currently, its banks in USA operate mainly down the East Coast, and it can continue to expand into the center of USA and go towards the West Coast. Now turning over to the financial health of the company, we can see in the previous quarter that TD reported, they actually managed to pull out a net income of $1.2 billion when the pandemic was in full force and the Canadian economy and the US economy was completely shut down. This puts their PE ratio, according to Google Finance, at 10.5. However, Wolfram Alpha reports it to be 13.98, and this is below their average PE ratio of 17.15 over the past 10 years. They also reported earnings per share of 80 cents per share. Currently, the bank also holds $152 billion in cash, which is actually more than the market cap. However, if we look at their balance sheet, we can see that the total assets and the total liabilities are roughly on par with each other, giving a total ratio of 1. TD Bank has also been increasing their PCL ratio, or the provision for credit loss ratio, to 1.76. And currently they have about $3.2 billion as provisions for credit loss. So this is basically when lenders default on their loans, TD Bank has the money to cover up their loans. And currently, with Canada giving out CERB and USA giving out stimulus checks, I don't think that the general consumer is at too high of a risk for going bankrupt, either defaulting on their credit card payments, on their loans like their mortgage or student debt. So I think TD Bank is in a very good position still, and the fact that they're increasing their provision for credit loss shows that they're being responsible with their cash. Now let's talk about the risks of this company. So first of all, their earnings per share at 80 cents per share is a little bit worrying to me because they currently pay out a dividend of 79 cents per share. So if TD doesn't pick up its operations from this point, they could be at risk of cutting the dividend in the long term going forward. However, in the short term, if they do earn less than 79 cents per share, they do have cash on the balance sheet to cover that to be able to continue paying out the dividend. Another risk is that TD Ameritrade also completely cut their commission fees last year, and this is because Robinhood continued to rise in the ranks, and these big brokerages that used to charge $10 per commission trade had to cut their commissions in order to compete. And likewise in Canada, we might see the similar shift happening in the years to come, because with the rise of WealthSimple as a platform charging $0 commission fees, I have no doubt in my mind that TD Direct Investing and other platforms are going to follow suit in the future. The saving grace in this all is that the TD Ameritrade platform only reported a net revenue decline of 11% from the year before. And this is because they saw a spike in trading volume due to COVID and people just being at home. And I think that with more investors coming online right now, we could see that these brokerages are able to sustain their business even though they're not charging commission fees. Now, the last company that we're going to talk about today is Blackberry. And for those of you who are in Canada or follow tech or knew anything about smartphones 10 years ago, you'll know that Blackberry was a shining star. Everyone loved the Blackberry devices for their security, and it was just hip to have a Blackberry. You know, it had that full QWERTY keyboard, you had that little trackball that you could rotate up and down to scroll through the screen, and you had BBM, which was all the rage. However, Blackberry has gone downhill from there and no longer sells hardware because they couldn't keep up with the iPhone, which eventually took over smartphones, and also Samsung came along, and just a bunch of other Android phones flooded the market and made Blackberry's operating system and their device obsolete. However, Blackberry has taken a different route and stopped pursuing the hardware route, and instead they're a software company now. The company provides intelligent security software and services to enterprises and governments around the world. So they have completely exited the consumer market. They currently secure more than 500 million endpoints, and 175 million of those endpoints are actually cars. Endpoints are devices that receive or send communications to a network. And what these endpoints are typically devices like computers, laptops, pagers if anyone still uses those, or IoT devices like smart home speakers or smart home monitors. The intelligent security software Blackberry offers leverages AI to learn and deliver innovative cybersecurity and data privacy. And how cyber attacks usually happen is through endpoints, such as your cell phone or your laptop, where viruses can enter into your laptop through websites or just through other backdoors, and they can be uploaded into the network and into the mainframe or databases of a company, and therefore that virus can spread and completely cripple a company's infrastructure. So put it plainly, a lot of companies will be depending on Blackberry software to secure their endpoints. And especially with this whole coronavirus pandemic that's happening, people are moving towards a work from home model, which means they need laptops, which means more endpoints for a company and more endpoints for viruses to be able to enter into the company's networks. So I think Blackberry will be able to piggyback onto this new trend in businesses. And on top of all this, Blackberry is also playing into another trend that's going to be happening very soon. And this is autonomous vehicles. And we know that autonomous vehicles are a perfect point for cyber criminals to be able to attack a city's infrastructure. Because if a cyber criminal can get into one vehicle and penetrate the entire network of vehicles, they can completely cripple a city's roads and rendering it useless. And we could have cyber warfare in the future. So Blackberry software is going to be critical when protecting autonomous vehicles from these cyber attacks. And currently, Blackberry actually services very high-value customers. They have 18 out of 20 of the G20 governments, they have 9 out of 10 of the top global banks, they have 9 out of 10 of the top automakers, and 5 out of 5 of the largest media companies as their customers. So as these companies continue to adopt more technology or build out their own technology platforms, Blackberry is going to be able to upsell their services and their security software to these companies. So how does a company earn money? Blackberry is essentially a software as a service company. So what they do is they sell their software for a subscription fee, and this is typically either a monthly or yearly subscription fee. So the 3 different ways that Blackberry makes money currently is through their Blackberry Spark platform. So this is their cyber defense, including endpoint protection, detection, and response. Through the Blackberry IoT solutions. So within this segment, there are things like operating systems for IoT devices, network communications, and product authentication. And this primarily comes from their expertise in providing security software through their Blackberry phones. And the last segment of the revenue is through the Blackberry IP licensing. So Blackberry, throughout the lifetime of the company, they've built up a lot of intellectual property, or IP. Currently, they hold 38,000 individual patents that are either have been approved or are pending right now. So that is a massive patent portfolio for any sort of company out there. So what companies can do is that they can license out their IP to other companies to use. So for example, if Blackberry has a novel software technique and another company wants to use it, they'll talk to Blackberry's IP licensing arm and ask to license that software for a fee. Now let's compare Blackberry with some of the players in their space, because I think this is very important when I look at this company. So mainly we'll be taking a look at cybersecurity companies. They might not necessarily be IoT cybersecurity companies, but let's take a look at cybersecurity companies in general. So currently Blackberry themselves, they have a PS ratio of 3.61, and they have a growth of negative 16.60%. This is because the company used to be a hardware company, and most of the revenues were derived from hardware sales. However, they've transitioned over into a software company and are still building up that revenue stream. So really, if we look at their software revenue growth year over year, it's roughly around 19%, according to their investor presentation. If we look at another company in the cybersecurity space, like CrowdStrike, they have a PS ratio of 43.29 and growth of 85.4% year over year. So they're very expensive in terms of their PS ratio. However, the growth of 85.4% is quite phenomenal, and it outpaces Blackberry's by 4 times. Looking at another Canadian company, Absolute Software, they have a PS ratio of 6.41 and a growth of 4.7% year over year, according to Yahoo Finance. So when we compare Blackberry to Absolute Software, personally, Blackberry seems like a bit more of an attractive investment because their PS ratio, it's roughly half of Absolute Software's, and their growth in terms of their software revenue is a lot higher than Absolute Software's. If we look at another company called Cloudflare, they have a PS ratio of 37.12 and growth of 47.8% year over year. So roughly double Blackberry's growth in terms of their software revenue. However, the PS ratio is at least more than 10 times greater than Blackberry's. Now, why am I interested in this seemingly dying Canadian company? Well, first of all, I think I'm interested in Blackberry because currently the prices that they trade at are quite low compared to their prices historically. And although the prices actually dropped around $4 in the pandemic, I think Blackberry today, trading at around $6.50, is actually a decent valuation for the company. And if you're looking to build up a position in this company, I think this is a great time to get started. However, for me, how I plan to trade Blackberry, because I do currently have a position which I'm down on a little bit, but I think I see an opportunity to swing trade this company. And if we look at the chart, we can see that Blackberry stock has actually been going up and down and up and down and up and down. And there's been a bit of a general downtrend. However, I think since March, where they hit their lows of around $4 per share, they've been going up since then. And I think that they're going to swing between $6 and $7 per share. It might even see the shares peak at $8 to $9. So I think right now the risk to reward ratio for Blackberry stock is favorable for any investor. They could potentially make $2 or $2.50 per share versus losing 50 cents. So in my books, this is a fairly good swing trade for the short term. And I think for the long term, as the company builds up its software offerings and IoT becomes a bigger part of society, Blackberry's revenue could see some dramatic increases year over year. However, the IoT industry has not grown as quick as market researchers have predicted. And this is why I think Blackberry stock has been selling off since around 2017. One other thing to note about Blackberry is that in 2014, their software revenue was only 3% of their total revenue. However, today, Blackberry's revenue is 98% software revenue. So we can see that the turnaround for this company has been fully completed in my books. And I think now John Chen as the CEO is going to be focused on growing this business and the revenues year over year. No longer do they have hardware or hardware expenses weighing down their net income. They're going to be able to fully capitalize on what a software's business gross margin should be. And Blackberry's gross margins right now are at around 67%, which is pretty solid for any sort of business out there. If we take a look at their financial health, they have a current ratio of around 1, which is okay for this company. It'd be nice to see if they had a current ratio of 2. And also looking at their cash flow, it was negative. But this only represented a decrease of 15% of the cash, which gives investors a little bit more confidence that the company has at least 1 to 2 years of runway. The latest quarter, they squeaked out a non-GAAP earnings of 2 cents per share. However, they had a GAAP net loss of $1.14 per share, and this is mostly due to their goodwill impairment. And what goodwill impairment means is that the goodwill that they reported on their balance sheet actually exceeded its fair value. So there was an expense reported this quarter that would decrease the value of the goodwill on the balance sheet. Some of the risk going forward for this company is that if IoT doesn't grow to as big as people predicted it to be, and I think IoT is really going to boom when 5G comes out, then Blackberry's business could be at risk because the total addressable market won't be as large as people thought, and maybe the space will become a little too crowded with all the competitors there, and Blackberry could be swallowed up. Also, Blackberry's brand has been tarnished over the years because of their failure in the hardware business. And if a brand is tarnished, this makes it hard going forward for the brand to be able to sell to other businesses, because those businesses will take a look at Blackberry through the hardware lens and be like, this company has failed before, so why should we trust them now? Also, the software revenue in Blackberry is not growing as quick as other software companies that we see right now that are in hyper growth mode. Blackberry's growth of 20% is great for a typical company. However, for growth software companies, we'd like to see growth somewhere between 40 to 90%. And lastly, they have a debenture that's going to be expiring in November this year, and this is roughly worth around $599 million. So the debenture is basically a loan that could be either converted into stock or repaid as a loan. So if Blackberry doesn't convert this debenture into stock, they're going to have to be paying whoever loaned them this money $599 million, and this will severely cripple the cash position that Blackberry currently has. So that concludes it for the 3 stocks that I'm looking to purchase in August of 2020. If you guys are interested in signing up for WealthSimple or QuestTrade, there's links down below and you can get some sort of offer, either $10 into your account for WealthSimple Trade or $50 in commission credits for QuestTrade. If you have any questions, leave them down below. Otherwise, smash that like button, subscribe button, and the notification bell, and we'll see you in the next one. Keep up the grind and have a great day.